Well, hello everyone. This is Shauna with TaxGoddess Live, and today we are here with Sean Wieland, one of our favorite financial experts. Sean is so good, so good at knowing all of the details and what's happening in the future. I swear this guy has a crystal ball somewhere because he's something, and then 6 months later it magically happens. But this is why we love Sean. So Sean, thank you so much for being here with us today.
Oh, happy to be here. Thanks for having me.
Oh, absolutely. We love having you here. So, today's topic, guys, we are talking about estate planning for the new regime. And this new set of rules, Sean, it makes me want to cry. And I should say they're not the new set of rules yet. Obviously, today is October 28th. We have until November 4th and maybe a few days after that until they figure out who our new president is going to be for this new regime. But I'm literally using the word regime in not a good way here, Sean, because depending on who is our new president, some of these rules are really, really scary. I know you've got hours to talk about on these new changes, but why don't you give us, some bullet points, some big picture theories, and then we're going to dive into the details. So what are you most concerned about with some of these proposed tax regulations?
So, there's been a lot written that kind of itemizes all the separate different proposals, but I haven't seen many people really get to kind of like the gist or the overview of what's being proposed. And essentially what it amounts to is that it's for lack of a better phrase, I know it's a bit cliche, it's a soak the rich policy aimed at capital owners. I think Elizabeth Warren's plan of doing a wealth tax couldn't quite get through, so they did everything just shy of that in this proposal. And a consequence of that is anytime anybody who owns anything of significant value is going to make some kind of move to buy a business, sell a business, trade stock, anything involving capital, they're going to be severely penalized for it and discouraged from doing so.
And let alone just the capital, if you make too much, you're also getting penalized here. This is literally going after the business owners, the people creating the jobs, the people that have the money because they're too rich. I want to smack somebody, Sean. I'm so upset by these proposed items. This is just so frustrating because you were explaining to me, you were talking about the markets. We've already had so many major impacts. COVID, the real estate is kind of being weird. This could be a pretty serious issue, right?
Right. So even before this coronavirus pandemic hit, the markets were already in a pretty fragile place and being propped up by added liquidity from the central banks. Which of course has been doubled and tripled since then. About $3-4 trillion has been added in already. There's another proposal in the pipeline for another $3 trillion added onto that. Basically, we're all living on borrowed money because the economy is shut down because nobody's allowed to go to work. Now, the danger here is because all of these taxes for any household making more than $400,000 to begin with, right? Which for a household, we're not necessarily talking the upper crust here. But to your point, they're going to be the people that, own the family businesses or the small businesses or the medium-sized businesses. And they're already under strain, adjusting to changing their business model, adapting to surviving in a COVID world. And now there's going to be a multitude of taxes and conditions that are going to inhibit them from adapting and making adjustments or selling their business. Maybe it's time for them to exit and they need to sell to a competitor. Maybe they need to buy a competitor as a strategic purchase, but now it's not as enticing or they're not able to because of these added tax burdens.
Yeah. And, it just feels like one hit after another hit after another hit. And hopefully, now you guys know, for any of our listeners out there, you guys know that I don't do politics, right? Politics are one thing. I don't follow the politics. We are talking tax. And that is my passion. And that's why we're here today, because again, some of these rules are just going to be a knock upside the head if this gets through. Okay. I'm not quite sure how else to say that much more politely than I really want to say that, Sean. And I'm very much of the same mind. And I'll just put it this way, that
I think the danger here is that optics have been placed ahead of pragmatism. So a desire to look tough on the millionaires and billionaires, as they say, has created a policy that might sound good to a certain class of people, but they haven't thought through the unintended consequences of implementing something like that. And as I've touched on top of dealing in a COVID-19 world and the restrictions that have been placed on that, and the fragility and the illiquidity of markets, the rise of passive investing, and the baby boomers retiring, it's a perfect storm of the largest and wealthiest population in the United States needing to sell their assets at a time that their assets are being frozen from doing so. And if the market can't clear, we're in real jeopardy.
Yeah. And you're hinting at it, but not saying it. We've got a baby boomer issue here as well, right? This is now when normally the baby boomers would be selling, they'd be moving their assets to their kids. They'd be doing whatever they're going to do as far as tax planning or any other kind of planning for that matter, getting the cash that they want to now retire on, these kinds of things. So, okay, I've calmed myself down enough. Let's see how worked up I get here, Sean. So let's hit on some of the specific points then. One of the things that right off the top, right, basically you kind of hit on it, $400,000 seems to be in the proposed. Guys, anybody listening, this is proposed. We do not have final bills. You guys know I will always tell you when the final, it's done and signed into law. So this is all about the proposals. So the current proposal is that anyone with an annual income over $400,000 will be increasing the top tax bracket from the current 37% back to the rates before 2018, which was 39.6. So really, Sean, you hit the nail on the head, in my opinion. A joint family income, husband and wife, both doing well, right? They're not extremely wealthy. These aren't the guys on yachts. This is a standard family in America. They're doing okay. They're doing well. 400,000 is not really a very high number. Do you have any thoughts on why they picked 400,000? It seems such a it's such a random number.
I don't know where that number came from. As you're touching on as well, that number is a number that includes all the mom and pop shops, the small businesses, the ones that have been hit the hardest by these lockdowns and shutdowns. And the nature of the way this plan is designed really has the airs of something like, frankly, class warfare attached to it. That, apparently if you make more than $400,000, you're part of the evil capitalist oppressor class, and anybody under that, are the oppressed. And they're the ones who are going to be footing these massive increases for basically doing anything in the realm of business, any kind of transaction, any kind of business expansion, anything that would actually get the economy going again and thriving, which was already under duress, both due to the lockdowns, the global pandemic, and the fact that the markets were already running hot from excess credit, before 2020 even started.
Yay for random numbers picked out of thin air. All right, well, let's stick on our $400,000 number here. One of the huge benefits that came about in the TCJA. Okay, guys, I'm gonna not use those initials because it's very difficult for me to actually say fast. I'm gonna call it the 2018 tax change. Okay, one of the major benefits in the 2018 tax change was the creation of something called the qualified business income tax deduction, and this really allowed anyone that had a flow-through business, so a partnership or an S corporation, to get an extra 20% tax deduction, depending on a whole bunch of factors. Okay, but basically it was free money for the business owners. Again, your mom and pops that are making 400,000. Well, guess what, guys? In these new proposals, if you are making more than 400,000, they are going to remove that, completely remove it, which is a huge problem. Now, not only are you not incentivized, to increase your profit over 400,000, you're actually incentivized to make it 399,999, right, by December 31st, of any given tax year. So, Sean, do you expect that loss of this free 20% tax deduction is going to cause issues with cash flow? what are you seeing?
Right. Well, that's exactly it, right? Is in terms of an effective rate, that's easily a 10%, jack up on taxes that they're going to have to pay. And if anybody thinks, okay, well, I'll just switch to a C corp because they just got their taxes lowered to 21%. Well, no, part of this is that that's going back up to 35%. So they're pretty thorough with this, that again, anybody making over that amount, which is anybody who owns any business of any considerable size, especially a size that would ever be able to have employees, they're just going to get whacked with this. And that money's got to come from somewhere, right?
Yay for those making $400,001. That's where that money's coming from. All right. Okay. So let's look at people that are now selling, these baby boomers. Okay. Mm-hmm. They're selling their business. They're passing it on to their heirs. Even people selling something like real estate, anybody selling something. Okay. There's a couple of different things that they're talking about hitting here. First one is that your long-term capital gains rates, which right now the maximum long-term capital gain rate is 20%. Okay. They're talking about increasing that to the ordinary tax rate. So if you're in that 400,000 or more of income, your long-term capital gains rate has now gone from 20% to 39.6%. An extra, effectively 20% tax on selling something, long-term capital gains. Okay. Mm-hmm. The planning is blowing up in my mind. Sean, how are you expecting that this is going to impact on your end?
Well, in addition to, the rush to the exits that we're dealing with right now, and what we specialize in is being creative and finding ways around this. So you're right that, the long-term capital gains rate is going up to nearly 40%. You can't even die to escape it because they're getting rid of the step up in cost basis, and they're reducing the the exemption amount by half of what you get for your estate. Probably the most common way that we address this is with an installment sale that gives our clients control of when and how much income they're going to take in a particular year. And they're still able to defer that. And for now, that's still off the radar. I often say that generally with the 400 section of the IRS tax code has to do with tax deferral because everybody's familiar with having a 401k through work. That's now under attack as well, that, they're reducing the dollar for dollar deduction that you get for contributing to IRAs, 401ks, that sort of thing. Now, of course, they're not reducing the taxes that you pay on income when you pull it out later in retirement. So effectively, it's a double tax. But that is certainly, under the eye of Sauron. And we have to move assets and do what's called asset repositioning to get these assets into a place where they can be transferred either to a seller or to your adult children in a way that you're not going to suffer these massive tax burdens.
Yep. And I think for me, it's one of the pieces that I have just been so frustrated with these proposals. I started off this meeting specifically talking about, I want to throttle somebody for even talking about this kind of stuff, right? Because when you're talking about removing, long-term capital gains going from 20% to 40%, you kind of hinted at it. We'll get to it in more detail. 1031 exchanges, which a lot of people are super familiar with, eliminated, gone, guys. If you make more than 400,000, that 1031 is gone. You're not even allowed to use it anymore. Okay, the step up in basis rules are going to be eliminated. Serious impacts if you are trying to sell or move any kind of asset. So, in the estate exemption, we'll get to that one here definitely in a minute because that one's just biting me. If you have assets, I think that's really one of the key things to look at here. All right. Mm-hmm. A lot of business owners, you start your business, you grow your business. Now you have staff, now you have teams, you're doing well, you're taking money home. You're not necessarily actually thinking about the bigger picture, right? Because unless you have generally an outside advisor that's saying, hey, your business is doing really well, we should probably get that valued. You've got other assets. You've been building this real estate portfolio over here. That could be worth some money, right? We probably need to be looking at this. And, good or bad, right? As I said, today's the 28th, November 4th or 10th, or whenever we find out who our president is, You had mentioned there's going to be a great exodus, basically. I think we're going to see tax planning skyrocket through the roof. And you called it asset positioning, which is perfect because you're going to have, if you're out there listening, guys, and you either make more than $400,000, okay, that's your first ladder step here, $400,000, or you're trying to sell a thing, a business, real estate, stocks that you've held forever and ever and ever, okay, or you have an estate worth more. We're going to get to this estate tax thing, but under the new proposals, worth more than $5.79 million. Okay, things people forget in their estate: you have a business that has value, you have stocks that have value, you have cash, you have jewelry, you have artwork, you have cars, you have insurance, you have all these things. Okay, if somebody is not helping you conglomerate all that information to determine whether or not your estate is going to have issues here, okay, and coordinating that with this current, now we're capital gains tax going up to 40%, losing 1031s, right? I think what we're really going to see here between November 5th, when we find out who the president is, and December 31st, I think all the attorneys, they're not even going to pick up the phone. They're going to be so busy setting up family limited partnerships, setting up irrevocable trusts, getting assets out of the names. So guys, really, sorry to kind of go on a little mini tangent here, but really, guys, if you guys have not picked a trust attorney, spoken to them in the past, you have one, but you haven't spoken to them in the past 10 years. You haven't updated your trust. You haven't called your financial advisor. You haven't called your insurance planner, Sean, and call Sean. You haven't called your tax advisor, tax planner, okay? Your tax planner plus your CPA. You guys need to have a team. And I know that I go off on rants about this all the time. You guys have to have a team. Well, now, we're at it, right? We have to know what's going on. So
yeah, now it's do or die. I mean, we I think we've all seen, Jurassic Park by now, where the mosquito gets frozen in amber for, then thousands of years. That's what's going to happen, assuming that this tax plan goes through. It's going to present a significant liquidity risk because the transaction costs in terms of tax penalties for making any kind of changes after it's enacted or after it goes into effect are going to be so severe that unless, death or illness forces that transaction, most people are going to try to defer, and they're not going to be able to hold out on that either because, the demographics of the people most likely to have these significant assets in real estate, in investment portfolios, stocks, bonds, mutual funds, that sort of thing, or just transferring their business is the baby boomer generation. Half their generation's already retired, and the other half is on its way. And they need that retirement income. They need that liquidity to pay their bills and enjoy the retirement that they've earned. And the people who are then going to buy those assets off of them need the liquidity to be able to afford to buy them. And if we have this straitjacket of tax law keeping everything frozen in place, frozen in amber like the mosquito, nobody's going to be able to make those adjustments. On top of the fact that we're already needing to make adjustments due to adapting to a world where we have to deal with coronavirus transmission.
Right. Okay. So let's talk about, we kind of hinted at it throughout all of that. Let's talk about 1031 exchange. You had mentioned the DST, the deferred sales trust. The 1031, just for any listeners that don't know what that is, 1031 exchange, after 2018 tax law change, the 1031 exchange allowed you to change one piece of property, real estate, for another piece of real estate, okay? Previous to 2018, you could have changed a business for real estate. You could have changed real estate for classic cars, right? There's all sorts of changes you could have done. But in 2018, it was real estate for real estate, has to be real estate. That's it, okay? Now, effectively what they're talking about, we'll go back to that $400,000 number, right? 1031 exchanges will be eliminated completely. Now, don't panic, okay? I just heard all my real estate people just squeak, right? Going, oh no, what's going on? Don't panic, because there are still other options to a 1031. The deferred sales trust is one of them. Sean, you want to give us a brief 1-minute kind of overview of the DST and how that works?
So based off a single piece of tax code, the 453 installment sale, It allows you tax deferral, hence being part of, Section 400. Everybody thinks of like a 401k, and same sort of idea as how required minimum distributions or how a pension or an annuity works. You're only taxed on the the distributions that you take out of it, and the rest is able to be deferred. And there's no limit on the size of the asset that is deferred. So you don't have any of those contribution limits like you have to worry about with IRAs, 401ks, life insurance, that sort of thing. And it's one of the provisions that hasn't been touched. I mean, again, because this proposed tax law is more about optics than about really thinking through the consequences. They kind of went for the obvious targets. They want to penalize everybody's 401k, and they want to penalize, their real estate 1031, and they're getting rid of the step up in cost basis. So anytime anybody is transferring any of the assets that people are most likely to own, that's what they're going for. But again, what we specialize in is some of these strategies that are a little more off the beaten path, that so far are untouched, that we can still reposition you in time to have that flexibility and to take control of your assets and when you're going to receive those distributions to hopefully stay under that $400,000 radar.
And I love, by the way, your phrasing about some of these strategies that are still yet untouched. Okay.
Mm-hmm.
Guys, I think we're going to have a very different outlook on the world depending again on who gets into the presidency. Okay. If Trump stays in, and you guys know this is not politics, if Trump stays in, I am not expecting a whole heck of a lot of change. He's done his stuff. He knows what he's doing. Trump himself has said, one of the side tangents, but related to this, that, he at the moment during campaigning, he is not doing anything with relation to additional stimulus or additional, help with PPP or anything like that. That has all been kind of placed on hold. If Trump stays in, it is the understanding that will basically be brought back up to the forefront, that they will be looking at that again.
I think there's also been proposal that, across the board, reducing long-term capital gains to the 15%, indexing cost basis to inflation, which is a major concern, especially if they've just printed $7 trillion in new money. We're certain to be faced with that inflation, which of course creates a bracket creep with that $400,000 ceiling. And payroll tax, I believe, is supposed to get some kind of relief as well. But again, these are all proposals.
And these are all, what you're talking about are all proposals in benefit of the American taxpayer. I think that's across the board in benefit to the American taxpayer, right? One of the things that really gets me is that the American dream, go make a business, go make it big, go make it work, go create jobs, okay? And all the people that did that are now getting penalized potentially under the new proposed rules, right? If Biden gets in, everybody that did the American dream is now getting penalized. And that's very frustrating for me.
Yeah, I mean, I'm very sympathetic to that. And, especially when we've already been crippled with these lockdowns because we've been, trying to do the right thing with this pandemic. Before the pandemic even occurred, the general gist of the tax code that was changed in 2018, as you mentioned, was really to encourage people to be entrepreneurs and business owners. It was very in favor of, well, if you're, a consultant, an independent contractor, a business owner, and you're doing 1099 instead of W-2, you're going to get a great tax benefit. And we've all been seeing that for the past couple of years. That is now, and now that, many of us have adjusted, say, to working from home or working through Zoom, or, we've had to change jobs because the job that we had, if you can't go into a retail shop or an office, they weren't able to keep you on. Now more people than ever have taken up that mantle of being the entrepreneur, the business owner. And right as they're getting started and right as we need them to make those adjustments to get the economy to bounce back is when they're going to get chopped off at the knees with tax penalties. It's an optics versus pragmatism thing that makes no sense to me.
Yeah. And you are being so calm and professional about it. I think my red hair is just making me want to, as I said, throttle somebody, but there we go.
When I discuss it with everyone privately, then I'll let my feelings fly a little more on this.
John, you're so good. All right. So then let's talk about this estate tax issue because, okay, so guys, this thing has moved around years and years. It's up and down and up and down and up and down. Okay. last major significant shift is that the estate tax was now, the max cap on that was 11.58 million. And so let me back up, let me give some details. Really what the estate tax is, there's two different pieces to gifting and estate, okay? Under the current law, the maximum estate limit is 11.58 million, which means that if you die, your parents, whoever, if somebody dies and they pass on their assets to somebody else, underneath 11.58 million, there is no tax to the person who died, right, to their estate, and there's no tax to the people that are receiving the assets. Typically, there's what's called a step-up basis. You heard Sean mention step-up basis. Typically, there's a step-up basis to fair market value of those assets on date of death because of this 11.58 million. All right. So, that's been an amazing tax strategy, really, is for people, because previous to this, the estate was 1.2 million, then it was like 2.4 million. It was very, very, very low numbers from that standpoint. Now, oh, sorry, Sean, go ahead.
Yeah, well, I just want to speak to that as well. There's a common misunderstanding, misapprehension that it's only the super wealthy that get inherited wealth, right? There's this idea of, oh, well, the super wealthy, they didn't earn it, they just inherited it from mom and dad. The reality is actually the opposite. The clients that we work with and the real life experience is that it's actually the people who haven't done so well that are most likely to inherit a business from their parents. If we think of family-owned farms or the family business, they're the ones who need that inherited wealth because they're going to carry on their family legacy. The people who've had the benefit of Ivy League education and the silver spoon, they've already created their wealth and they've started their businesses and they're off and running, and they don't really need mom and dad's help or carrying on that legacy anymore. It might be nice, but they don't need it. So this penalty against inherited wealth actually harms the people who are most likely to, again, to have those family farms, the family business. The people that you would think would, there'd be the desire to help, they're the ones who are going to be hurt the most by this.
Yeah, and thank you, because that is a great perspective. And you're right. Most people think exactly what you just said, right? These are the super wealthy and they're trying to escape the tax. No, no. So, okay. So basically the current estate exemption as it stands is 11.58 million. Under the proposals, we're talking about going back down to 5.79 million. Now, again, as Sean's saying, right, well, that's only the super wealthy. No, it's not. This is somebody with a business, right? Let's say, a $5 million business for sales price purposes could be making $2 or $3 million a year, but they have a lot of assets. They have a great client list. They have, a great brand. Google wants to buy them, and so they get a massive sales price, right? Because Google's decided they want to get into this particular field. We had a lot of businesses that, for example, were in the personal protection equipment business, right? And previous to COVID, they were doing okay. COVID hit, and now they're doing more than okay, right? Because they're selling what everybody needs. So, this particular issue to me is huge, because you really only have, once we find out who the president is going to be, right? So let's say it's now November 10th. We now know who the president is going to be. That leaves you November 10th through December 31st, leaves you 6 weeks to do a significant amount of complex planning, okay? This is not as simple as, I'm just going to call my attorney and he's going to set up a trust and we're going to move stuff, right? That is not this level of planning. What you were talking about here is coordinating between your insurance professional, your attorney, your real estate professional. You need to get valuations. You need to get a certified valuation analyst, because you might have to calculate discounts on the value of the business to get it to move, right? You need your CPA, you need your tax planner, right? You're trying to coordinate potentially 6 or 7 or 8 professionals within the span of 6 weeks. And unfortunately, it's not just going to be you, right? There's going to be 1,000,001 people that went, oh no, right? Now Biden got in, or what? Here are the changes that are going to happen. And now we've got a problem. So, one of the most common issues that I hear, Sean, I'd love to hear issues that you hear about this estate thing and about getting people to actually plan. Okay, that's really where my comment is going to go here, because one of the things that we hear just over and over and over again is, well, that's never going to happen. They can have it when I'm dead, right? They'll get my cash when I die. The assets aren't worth that much. There's no way my estate is worth $5 million. I don't need to worry about it. Okay, but they've never had any actual professional eyes on any of their stuff. Okay. All I'm saying, I guess from my perspective, is please do a little bit of homework, just a little bit. Talk to your professional team. Talk to your valuation people. Talk to whoever you need to talk to. It's as simple as a 30-minute telephone call going, hey, if Biden gets in, what are we going to do? Like, what's the plan, right? So that you can start thinking about this. And, at this point, it's 6 weeks plus 1 week because we're already at October 28th. But, Sean, what other advice do you have for people that might maybe be sitting on the edge and they're just, do I need to do something? Do I not need to do something? How do we help them get over the hump to do something here?
Well, I think you've covered it. The thing is that you're not going to be able to do it alone. You need a team. You need professional advice. And the truly ultra wealthy, the billionaires of the world, they've, almost certainly have already created these structures. They already have these things in place. They're not the ones who are going to get soaked by this tax policy. It's the people in the middle who've done well, but they haven't done the rest of the planning that goes on with that success. And they need to follow in the footsteps of those other people to do those like-minded things, because they're the ones who are going to be hit the hardest. So it really is, and it's not something that can be done overnight. It's not something where, you just create a trust or something and it's done in a week. It takes a bit of planning, a bit of work. It has to be tailored to your particular situation and your particular business. And it's getting that planning started that is going to make that possible. There is a solution. There's going to be a creative way out of this. There is some way to pivot and protect and adjust these assets so that you can still do what you want to do. But the tighter the straitjacket, the more, frankly, complicated the solution is going to be. And you're going to need a professional to help guide you through that process.
Yeah. And that feels like a straitjacket. That is, sure, Sean, you actually just made me lose my voice. That was the perfect reason. So, fantastic. Okay, so then, the only other, unless we've got anything else on the estate side, the only other piece that really stood out to me, I mean, there's lots of pieces in this code, but Sean and I could talk for hours about this stuff, and I don't want you all getting bored, let's put it that way. So obviously, if you need financial help, insurance help, Sean, we love Sean. He's great. He's got the planning. He's got these extra tools and these ways to get around things. But again, you got to make the call. Of course, you guys know me. If you're looking for something, TaxGoddess is working basically 16 hours a day at this point, because this is what's happening. This is the planning that is going into what's happening. So TaxGoddess team is here. So if you guys have questions, feel free to reach out to us on any of our channels. Of course, you can go to Sean, website name?
Tannhauser.financial, TANNHAUSER.financial. All my contact information is there. Please feel free to reach out. Happy to have a complimentary discussion, learn if it will be a good fit, how exactly I'm going to be able to help you, and you can decide from there.
Awesome. And of course, you guys know you can find us at TaxGoddess.com. So super simple from that standpoint. So let's talk about one of the very last ones, which is the corporate tax rate. I was so happy, Sean, when they cut the corporate tax rate from the old 35% down to 21%. There was so much amazing, awesome tax planning that we can do with the C Corp tax rates now being 21%. I could cry because they want to put it back to 35%, Sean, 35%. So, again, we're just losing the ability to write things off. We're losing the ability to plan. Sean, any specific impacts, anything from the C Corp side that you're seeing that's going to cause problems?
So again, those more advanced strategies that don't have this Eye of Sauron upon them are still available for C Corp. So really that's more of a one-on-one conversation, but there's definitely ways that we can still, even though they're severely limiting what deductions are possible, there's still ways that we can deduct that income from the business and put it in a tax preferred vehicle that will be able to provide relief even within that C Corp structure.
And so, guys, I hope you heard that, but I'm going to repeat it just to make sure you guys heard that. Yep. There are super secret ways to do this stuff, okay? But you must work with a professional. This is not something that Sean or I can just say on a video and you guys can be like, I'm going to go to LegalZoom and set up my thing. It does not work that way, all right? I love you guys, but it doesn't work that way. So we have covered a lot today, Sean, and I know we're 5 minutes over. You are so kind to continue chatting. What is the biggest takeaway in your mind for our listeners today that they need to know about these proposed changes?
It's time is of the essence. That straitjacket is being laced up. And if you're going to make the adjustments that you need to stay flexible and adapt to this rapidly changing world we live in and how crazy 2020 has been, you're going to have to start that process to make those moves, because, should this finally go through, your options are going to be very limited by that point, and it's going to be too late for the shoulda, coulda, wouldas. You need to start this process now and move it to a place where you're going to have that freedom and flexibility to make those decisions.
And guys, I'm going to throw out my last and final comment is, listen, even if Biden doesn't come in, they have been going after this for years. Mm-hmm. They keep bringing this up. They keep talking about, for example, S corporations having to pay self-employment tax on every single dollar of income. They keep talking about there's going to be some sort of special income limit where now you're going to be the uber wealthy and you're going to pay the highest tax rate. They have been going after this stuff for years. So even if Trump gets in, y'all know he can only be in for another 4 years, right? That's it. So if you don't do it today, if Trump gets in, fine, you're taking your risks. You do what you got to do, right? But in the next 4 years, you better start doing your planning, because we're going to have to see what the world looks like 4 years from now. And of course, you need help planning, reach out to us. That's why we're here. So again, Tannhauser.financial for Sean. And of course, you can go TaxGoddess.com for me. So thanks so much for being here with us, Sean. It was so sweet of you, as usual, to share the big brain on Sean with TaxGoddess and our listeners. So thank you.
Happy to help. Thank you.
Awesome. Have a great day, everybody, and we'll talk to you later.